Good day to all of you, and thank you very much for joining this ICMA video interview with Ashley Alder. My name is Martin Scheck. I'm the Chief Executive of the International Capital Market Association. And as you probably know, we're an international trade association focused on the operation of the international debt securities markets. Our members are issuers, they're intermediaries, they're investors, market infrastructure providers, a number of central banks as members, all of them involved in the debt capital markets. About 30% of our members are headquartered in Asia and serviced from our office in Hong Kong. Now, during the course of the pandemic, we've been holding a series of podcasts, webinars, and interviews covering many aspects of the capital markets. And you can find these on the COVID-19 Hub on our website. So moving forward today, I'm delighted to be joined by Ashley Alder. And Ashley has been Chief Executive Officer of the Securities and Futures Commission since the 1st of October 2011, and currently is also Chairman of the Board of the International Organization of Securities Commissions, IOSCO, very influential, and sits on the Financial Stability Board's plenary and its steering committee. Started his career as a lawyer in London, practiced in Hong Kong for more than 20 years, Executive Director of the SFC's Corporate Finance Division, returned to one of the international law firms prior to taking up the current role. Ashley also chairs the SFC's Executive Committee, the Nominations Committee, sits on the Budget Committee, the Investment Committee, the Advisory Committee, and the SFC HKEC Listing Committee. Member of the Financial Leaders Forum, Council Member of the Treasury Markets Association, and Vice President of the Hong Kong Institute of Bankers. So clearly, Ashley, you're extremely busy. So moving on, Hong Kong is, as we all know, a hugely important Asian financial hub, and it's also seen as the gateway to the vast capital markets of mainland China. So Ashley, you're very, very welcome. Thank you so much for joining us today to share some of your views on the Hong Kong financial markets and how they've coped during the crisis. Let's delve right in. But there's a big question out there, and before we talk about the pandemic and its impact, let's address that. And the question is, whether it's a fair question or not, the global markets are asking about China's new National Securities Law. What does it mean for your financial markets, for the financial community operating in Hong Kong, and for the SFC itself? So if I can pose that question to you, Ashley, please.
Yeah, I mean, it's a direct question. I think it's a fair question. so I'll attempt to answer it. Now, first point is, just more broadly, Hong Kong has been, without doubt, going through a series of challenges over the last 18 months or so. And of course, last year and a little bit into this year, that was focused on the protest movement in Hong Kong, which, purely looking at it from a financial center perspective, did concern firms operating in Hong Kong, more so from a operational perspective than anything else. So that we did have a kind of dry run here around the working from home concept, even back then. So that's first thing. Second thing, of course, and I'll get onto it, is the sort of run up to and then the implementation or introduction of National Securities Law, and then thirdly, COVID. So it's kind of three sort of challenges that Hong Kong's been dealing with. Actually, COVID, so far at least, has, relatively speaking, I say relative to Europe or much of Europe and the US, Brazil, elsewhere, COVID has been handled pretty well in Hong Kong so far. And that is both as to infection rates and as to mortality rate for the population here. So I just set that to one side, and of course we can talk about this later on as to how we have responded to, as a regulator, to the COVID situation. So far as NSL is concerned, well, look, it's a fact on the ground. It was implemented now 3 weeks ago, actually. What have we been doing as a regulator? I mean, clearly we have to approach this with a regulatory hat on because it's the only hat that we have. We are not in a position as a markets regulator to give any kind of authoritative interpretation of national security law. But nevertheless, as a market regulator which administers the whole kind of, set of rules and regulations around how capital markets should operate, we do clearly have an interest, in the whole topic. And the interest is fundamentally around the fact that many of those laws, regulation, rules, codes of conduct and such like that we administer revolve around a philosophy which is not unusual to any international financial center, which is around access to and use of and transmission of information. Information is all around, familiar concepts such as, reliable price discovery, etc. Is hardwired into the rules that we administer and we enforce and we supervise. The first thing we did, in that context, and also looking obviously at our interest in the way in which firms themselves need to risk manage their situation, whether business risks, legal risks, and others, is to go out to quite a broad set of larger global firms operating in Hong Kong, really to get a better understanding of where their thoughts around the landscape after the implementation of national security law. And, in a nutshell, and this is oversimplifying it, is that the first comment is that a kind of overwhelming commitment to continue to operate in Hong Kong and invest through Hong Kong into mainland China and to intermediate those capital flows. And, as you mentioned at the beginning, Hong Kong is a place that always transforms itself. It faces regular, serious challenges that are painted particularly by the international press, as existential. And what it usually does is reconfigure, reset, and then comes through stronger. And so the firms are basically saying to us, look, investment opportunities and interest and flows, Hong Kong as an intermediary plays an absolutely critical role, and we want to be part of that. And we fully intend to be part of that. On top of that, you will have seen, again, some of this is sort of counterintuitive to an extent, that in recent months, the mainland authorities have lifted ownership caps for intermediaries of various types, fund companies, as well as brokers or investment banks in mainland China. So there's also, firms are taking action in order to ensure that they have operations which they control 100% or that they majority control. So that's obviously the mainland operations competing in the mainland domestic market. Hong Kong is much more around the intermediation of flows. And you'll have seen that, for example, there has been an uptick in listings in Hong Kong, which are basically dual listings with the US. And that's very, very active. And you've seen from the newspapers, from the media, that there is a prospect of Ant Financial, which, and you've seen also from the media that there's guesswork about the size of that, hovering around $200 billion as a listing, both in Hong Kong and in the mainland. And the volume of what we call in Hong Kong, because we are south, the mainland is north, northbound flows through Stock Connect have increased enormously. They're very, very active. I mean, the trajectory has just gone like this. So all that, there are other statistics I could trot out, but basically all that demonstrates a very high level of interest in maintaining that activity and growing it. So when it comes to, so that's the first point. When it comes to NSL, most firms are kind of adopting, as far as we can see, a sort of wait and see approach. But look, they do have concerns around the interpretation of the scope of NSL in a few dimensions, and also it's the way in which it's implemented, which I can connect. And those are the obvious questions that are asked. I think it's actually a bit overambitious to think that there are going to be perfect answers around both those elements, scope and implementation, within a few days. What we did, quite deliberately, of course, because we were, after we had all these meetings, was to issue a statement which basically said this. It firstly referred to a letter that Hong Kong's financial secretary, who is the finance minister here, had issued, I think on the Friday, giving sort of levels of assurance around national security law and Hong Kong as an international financial centre and business as usual. We said in our statement that we had passed on views and concerns that firms had from our series of meetings to the government, and that we welcomed that letter. Okay, so that was the first thing. The second thing we said is that recognising that we do not have the power of interpretation, it's not in our jurisdiction. On the other hand, there was nothing of which we were aware in the NSL that should adversely affect a few vital aspects of the way in which markets normally function. The first was the point I raised earlier on about information, which is from the production of research reports, including the sort of opinions that research reports would normally expect to contain, and data that they were normally expected to retain, through to due diligence exercises, which in Hong Kong are particularly important in the context of listings. It's a very, very active listing market. And a few other examples, but basically those are the two we kind of landed on because they're easy to understand. We weren't aware of anything in the NSL that would cause any of that to change. We also referred to types of market activity that had been raised to us as a potential concern. So, for example, short selling. Short selling implying a criticism of a business, a policy, whatever it might be. And again, we have a short selling regime in Hong Kong that is hardwired. We have not, even though we have been lobbied in the past around this, we have not banned short selling. We did not do that during the COVID crisis. In Hong Kong, we do not believe that the arguments around banning short selling stack up. And we have a regime in any event that contains a few speed bumps when it comes to short selling, such as uptick rule and such like. Anyway, that's the technical issues around short selling. But basically, again, there's nothing of which we were aware after, which should cause anyone to be reticent about the way in which they short sell or hedge or conduct other sort of market strategies. So there was more in our statement, but that was kind of the essence of it, because clearly we wanted to pick up some of the key concerns and then express our view as a regulator around this. And in essence, the way we looked at it was a little bit like a sort of Venn diagram as to NSL in one circle, market rules and the way in which we operate. And of course, market participants, it's not a free-for-all around expressing any opinion you feel like. There's got to be questions of competence, there's got to be questions of judgment and such like, and they are bounded, but from a regulatory perspective. And so the Venn diagram, basically, as far as we could see, could boil down in those areas to NSL being in one circle, the activities that we regulate and the way we expect them to be carried out as before going into the future, and those two circles not intersecting. So that's, in essence, the message we were passing out, but with a heavy caveat that it is not our role, remit, or jurisdiction to interpret NSL. So, and we're continuing to have discussions with firms bilaterally in the main to see how their thinking evolves. So that's really it in I was going to say in a nutshell, in a kind of larger thing than a nutshell, whatever that might be.
It's clearly a complex issue. Thank you very much for that, Ashley. And the focus, I think, that you brought out on information and types of market activity and the clarity that's going to come over the scope and implementation of the NSLs, that's very important for people to listen to, I think. Let's move on, if we may, and move back to the COVID-19 situation, where I know that there's been a little bit of a flare-up in Hong Kong recently, but Hong Kong was one of the first, if not the first, of the global financial centers to be affected.
Yeah.
For you, I guess there have been some particular challenges at the SSC, for example, supervision and enforcement during the pandemic, traders working from home, licensees working from abroad, remote working generally, firms having difficulties in meeting deadlines, accounting issues, cybersecurity, and the list goes on. Be very interested to hear a little bit from you as to how you manage these challenges.
Yeah. Well, actually, I think all the regulators I speak to, so, through the IOSCO lens, as it were, sort of have pretty much the same experience we have, which is notwithstanding when the pandemic kind of hit them, as it were. Although we had to work, move very rapidly around, degrees of regulatory relief, deferrals of reporting deadlines. There's a very, very long list, but basically operational flexibility. Most found the same thing, which is that the degree to which financial markets are now intermediated through technology meant that by and large it was pretty smooth. That's certainly what we found in Hong Kong. So, like most other markets, most of our participants defaulted to working at home. We did, as I say, have a practice run at this last year in the context of protests in Hong Kong. So we were, this is sort of round 2 for us. And the issues became sort of fairly familiar, which was, so far as firms are concerned, it was a combination of altering the way in which we supervise. So of course, on-site inspections had to be, we didn't do them for a period. We're now also deciding to pull back from that because the rate of infections is going up a little bit in Hong Kong. But nevertheless, there are other ways in which we could supervise remotely. Everyone has been dealing with the question of trading and records and recording. And we've managed to find solutions to that. Regulatory reporting, clearly you have to recognize there are delays, not least because the postal service has not been as regular as it has been in the past. But all of these are very practical. But what we basically found is that there's had to be a minimal amount of default to other centers. Not surprising, because other centers are in the same boat. So there hasn't been a great deal of, we have to go offshore working and such like. And that combination of reliefs, reporting deadlines, pulling back on, on-site inspections and such like has been very, as I say, a consistent experience, and so far so good. I should just say a few things. Firstly, we always adopt an outcomes-based approach, and notwithstanding the fact that there may have been relaxations or reliefs or accommodation, we are laser focused on the regulatory outcome being as close to identical as normal working as possible in terms of assurance. And the second is that the question is often asked of us, can we make this permanent? That's a totally separate conversation. So the answer to that is, yes, there's an accommodation of various types, but the conversation about how permanent some of this might be would have to be taken up separately, because that's a very different conversation to one around dealing with temporarily with a crisis. And then in terms of what we've been dealing with otherwise, the categories are actually very straightforward. It's firms and firms' supervision and reliefs around working from home. It's clearing, and in particular, working really closely with the clearing houses on margin. And again, I think the global experience is that, thank God, really, the clearing, the new derivatives clearing ecosystem globally has worked as expected. It should. And we were very, very focused, both in Hong Kong but also globally, on this interaction between volatility, margin, and procyclicality through the system. And again, I think that's been managed pretty well. We have not seen any procyclical blowbacks from margin calls in the clearing system that are systemic. We've seen individual firm and particular kind of leveraged hedge fund outcomes that have put some stress on the institution, not the FMI, not the clearinghouse, but more on the fund. And that's usually when there's a prime brokerage margin call and that kind of flood that goes through into the the assets. But that's been idiosyncratic more than anything else. So that's on the clearing side. On listed companies, that's, again, practicalities around how to conduct an audit and how to hold an annual general meeting. Interesting, the audits, there was a kind of huge measure of concern voiced by auditors around, we can't do an audit. This is a few months ago. This is the start of the crisis. And we can't do the work necessarily to sign off on the preliminary results announcements, etc. Actually, in the end, with a kind of, a sort of reset as to how you work, the outcome has been results have been issued on time and audited. In the overwhelming majority of cases, there is an issue which is now current around what people tend to call COVID-19 reporting. And I think most of you will have seen that there's a lot of commentary around the use of special measures or measurements in accounts to trying to tackle this, whether they're justified or not, and also a whole set of questions around going concern, goodwill write-off, etc. But that's a kind of different set of accounting standards issues, and also the interaction of auditors with firms under stress. And then just more prosaically, as I mentioned earlier on, we've dealt with supervision. We just have to flex the way we supervise. And one of the tools we use in our enforcement division, which is important to us in Hong Kong, and I'm sure it is elsewhere, is the ability to execute search warrants. Of course, that's a physical activity. And again, temporarily we pull back from doing that because not least to protect from a medical perspective or a health perspective those who might be in the premises we search, but also our own staff. So that's really about the size of it. But actually, so far, so good, I think.
Yeah, I think we're hearing that a lot around the world, and certainly from a market perspective, the accommodations that have been offered by the regulatory and the official community have been very, very welcome and really contributed to keeping the markets going as well as possible during the course of the crisis. And you mentioned the role of financial technology, and all of this wouldn't have been possible without some of the systems that we have at the moment. And one of the things we grapple with is looking into the future and trying to work out where we should focus our attention on fintech going forward and what's going to have the most impact on the markets. And I'd be very interested to hear your views as to whether you have any particular areas of interest that you're particularly focused on.
Well, I think it's actually, in reality, it's a familiar list, but it's really been brought into focus, in a sense, by the success of a default to remote working, which just basically demonstrates the degree to which technology is fundamental to the financial system. But I think the topics that we will be looking at, and certainly we've got current work, some of it published, some of it not yet, some of it in consultation in IOSCO, and they still need to be thought about, and they range from AI ethics, basically. This is the old one, which is you can't come to us as a regulator and say, well, I'm sorry, it all went terribly wrong. It's the machine did it, not me or us. That's so it's the ethics and responsibility and explainability, etc. All those topics around AI and machine learning, etc. I think have been brought into focus. Cloud computing, definitely, again, brought into focus, again, from a regulatory perspective, that is all, in large part around the location of records and accessibility of records, both from a supervisory but also an enforcement perspective. So that's key. And again, it's something that still needs to be worked through. IOSCO, again, has been doing a lot of work on cloud. I think other regulators have as well, possibly ESMA, if I recall. Again, there are live issues. And linked with all of that is this broader concept of outsourcing, which has been bubbling around as a topic for quite some time. Quite a few reports have been written around it and such like. But this question of vital financial services operations being carried out by unregulated entities, and then the responsibility on the regulated entity to effectively act as the regulator's sort of proxy to deal with those outsourced firms, but then take responsibility when things go wrong. That's still kind of the default approach. So the question is much broader. And then, of course, last year, the whole stablecoin debate kind of turbocharged the crypto asset sort of environment became very, very important, because then it triggered not only a broad set of concerns about financial technology, ranging from payment systems through to AML implications, investor protection, the stability of currencies. It was a huge set of issues it raised. But of course now it's kind of transformed into a larger debate about central bank digital currencies as well. So all I can say is a huge amount going on. And I think, the COVID crisis has just highlighted and sort of turbocharged these issues a little bit.
That's interesting. I mean, the pandemic has indeed been an accelerant for many, many segments of the market. And one segment that's very close to us is sustainable finance. And that's sort of green, social, sustainability-linked bonds, sustainability bonds generally. And I know that Hong Kong has been a leader in this in Asia. And we're starting to see that regulators are getting more increasingly involved in putting some bounds around, for example, areas such as disclosure. They're very interested to get your views as to the role of securities regulators in this market. And also, one of the, sorry, it's a slightly longer question, but one of the concerns that we had, and I'm not sure whether this will be borne out, is that with the huge focus on social bonds and COVID-19 themed bonds as a result of the crisis, green might be slightly left behind and have be less of a focus, as we all think is extremely important. Be interested to get your views on that, if we may, Ashley.
I think it's just to be honest with you, I think it's a bit too early to say on that. Clearly the atmosphere, if I can use that word, in the run-up to the COVID was hyper-focused on climate change and how regulators, in our world, how regulators were dealing with that. I think it's too early to say, firstly, the extent to which the effort moves full bore into the social aspects, elements of which have been uncovered effectively by COVID. I think we know, roughly what they are. But it's extending now. There's far greater concern around supply chain issues and labour issues around supply chains, etc., which have been around for some time. They've been brought into focus, and also just the way in which I suppose there's this debate about bankers, regulators, people operating the financial system may have thought they were essential, but then when it came to lockdowns, those who are essential are people on short-term contracts, gig economy and such like. And that also is informing the sort of, the social aspect of sustainability. So I think it's got some way to run. My view is something like this, which is, I don't think that in any way detracts from the focus on environment and climate. If anything, I think the COVID crisis, which was, as a sort of black swan, has focused people's minds on the sort of risks they prefer not to think about. One of the issues around climate change, setting aside all the politics around it, is that it is one of those risks due to its relatively sort of long tail. It seemed to be too far in the future for people to comprehend. That is one of those risks that I think now people will start or have started focusing on a lot more seriously, because they can kind of put it in the same bucket as one of the, even though it's much more immediate, an expected risk like, unexpected black swan like COVID. So we are in the IOSCO, I'll just mention one thing, which is we're doing a fair amount in Hong Kong, but a cross-agency effort around this, but it kind of mirrors in a sense what the IOSCO Sustainability Group is doing. That's led by Eric Thieden, who's the chair in Sweden. And it's really around work that I think is going to end up with some tangible outcomes from a securities markets regulator perspective in the run-up to COP26, which has now been deferred to, I think it's next November in the UK. And the importance, really, the key issue for us as securities regulators is that lots and lots of voluntary standards, some picked up more than others, such as TCFD, which is a sophisticated disclosure scheme. a lot of kind of noise in the system and a lot of voluntary stuff going on. There's a really tough question to which we don't have the answer yet, which is to what extent should some of the type of disclosure, particularly at a corporate level, have a mandatory auditable component. And I know that, the IFRS is also, IFRS is now working on this from its perspective, because it obviously has a traditional remit around financial disclosures, and there may be some commonality around how we as securities regulators look at this and IFRS. Fundamentally, what this boils down to is a very old-fashioned concept, which is disclosure of material risks. What is material, what must you disclose? And so far as corporates are concerned, it basically these days falls into three buckets, one of which is your own effect on the environment, which is, when it comes to carbon, is scope 1, 2, and 3. Being very, very careful around double counting and things like that. The second is the TCFD style disclosure, which is more around impact on you and framed in the context of financial risk for you, from either physical risks to your asset base or portfolio, or transition risks, which is anchored to the potential for climate and environmental policy to affect you. And then the third one, which is a bit newer, is our increased expectations by some investors around firms setting their own carbon intensity targets. That's relatively new. This is net zero by. You've seen BP going down that path. But that's the kind of size of it. I mean, in short, I actually don't think that the broadening of concerns under sustainability to social is going to dilute the environmental climate. I think the COVID itself has kind of highlighted both.
Yeah, I think we'd agree with you there. I think it's made it much more, ESG is now truly multifaceted, and I think that's a good thing. And it's interesting to see that a lot of the major programs for driving the recovery and economic growth is hardwiring environmental issues into the disbursement of funds. I wanted one question, if I may, which is non-COVID related, which is on the China Securities Law, not to be confused with the National Securities Law. And the last one I wanted to touch on was a sort of more catch-all question about your role at IOSCO. So on the China Securities Law, that came into effect at the start of March. We've been following that. We actually welcome it. And I think, if I'm not mistaken, the reforms are intended to streamline the process of issuing securities in onshore markets and to enhance investor protection, which should have the impact of helping to open up China's markets to international participants. And that, I imagine, would be good for Hong Kong as a financial center. But interested to get your perspective, please.
Yeah, I mean, the short answer to this is that the greater degree to which the mainland markets achieve their ambition of moving away from a system where, for example, regulators have controlled IPO pricing, for example, and also have intervened quite frequently in the markets, and where investor protection has been dealt with differently to the West, to one that basically is moving to the sort of market structure and regulatory approach that we're familiar with, whether it's London or New York. That is the trajectory. It's quite deliberate. I think it's quite difficult for a market that is so relatively young and extremely large and still relatively retail dominated to kind of take the leap to do that. But the new Star Market, which is a tech board in Shanghai, is the kind of pathfinder for this. And then, so far as Hong Kong is concerned, it can only be of benefit because then flows through Hong Kong, those channels we discussed earlier on, into the mainland, for one thing, will become a lot more stable. Because these reforms effectively encourage patient capital far more patient capital, both in terms of time of investment as well as extent of investment. And also, other markets, you've seen that other asset classes have been opened up as well. I see Hong Kong as a place where, over time, it continues to shift up the value chain, as it were, and is a place where not only can you access that, if you're an international investor, through these channels, which are firmly anchored in the Hong Kong system, regulatory system itself, but also where you can risk manage your onshore positions or your made in China positions as we sort of go up the value chain. Because risk managing these positions is quite a complex job, and I think we're well suited to do that.
Okay, thank you. Now, finally, you are chair of IOSCO, so in that context, you have a global role. And for many, many years, globalization was a theme, and integrated capital markets were the accepted wisdom that these were the best way for markets to operate effectively. We've seen a move to counter that recently. You mentioned in a different context, supply chains. We've seen people wanting to bring supply chains onshore. We've seen barriers put up between various different capital markets. And I know that IOSCO, this is something which is a major focus. I'd be very, very keen to get your views as to whether you think the world is moving to a more fragmented national market type structure, or whether you think that the integrated capital markets model, where capital can move relatively freely across borders, is something which will be pursued in the future.
Yeah, I think sort of jury's out on that bit, because right now I don't see any significant impact so far of geopolitics on capital flows as we've been used to it so far. You can see areas of potential concern, but also areas of more, how can I put it, more sort of hope, as it were. So, areas of concern, I mean, clearly issues in Europe around Brexit and around Switzerland, where you are, are kind of a special case. And it kind of all revolves around a combination of politics and this concept of equivalence. And I think that is a special case. And it does look to me from a distance that is something that could be, financial market regulators, when shorn of politics, tend to be quite sensible, and they look at what's the sort of safest and soundest way of conducting activity, and how do we cooperate to supervise properly. That's kind of the starting point, shorn of politics. So I think that from what I see, that's the kind of direction in which this is going, sort of including in Europe, but they're not without some risks. You may have seen recently, I think the CFTC in the US, I think it kind of started finalizing its cross-border approach, which was sort of very much sort of kicked off by Christian Carlo, and then I think carried on when he was chair, last but one, then carried on by Heath, the current chair, which again is there's appropriate reliance on overseas regulators for key activities, which is in part directed to ensure that cross-border flows can occur in a way that is systemically and from a regulatory perspective is safe. But nevertheless, those flows are encouraged. IOSCO published a report, I think it was in April, after a long process, I have to say. We published a report back in 2015 on the same point, which was basically cross-border regulation, and this time it was under the heading of fragmentation. But that fundamentally focused on the concept of deference, which is kind of equivalence is kind of an expression of that. It's a new term that's used in Europe, often not elsewhere, but nevertheless. And that came out with a set of effectively best practices as to how you do it, right through the chain from what happens when you're assessing a jurisdiction, if you want to assess a jurisdiction to be equivalent or to defer to, right through to the decision, through to how you manage it once you've decided with the supervisory relationship. And then what happens if you feel that the rules have, I know this is a politically loaded term or word, diverged, such that you may need to reassess. And what do you do? There's a set of best practices that we published around that. So, but obviously the best practices are around these are the ways in which regulators could operate with an overall objective to ensuring that cross-border flows are maintained, notwithstanding deglobalization, effectively in other areas. So I think that's, and you can see in Hong Kong, just going back where I am, as Hong Kong and the regulators here are fundamentally around managing the risks arising from huge volumes of cross-border flows. That's what we do. Hong Kong is an open international financial center, and the liquidity in our market is entirely international. Well, that's pretty big. We've got about 30% retail in Hong Kong in our local markets, but the bulk of the flows are international. International into Hong Kong, but also international through Hong Kong into mainland China, and from mainland China into our markets in Hong Kong. So all of that paints a picture which is far from gloomy, but so I think so far there's a difference between the rhetoric and the politics around deglobalization, which is real without any doubt whatsoever, and isolationary tendencies and such like, but what we're seeing on the ground when it comes to markets, really.
Yeah, well, we share that. I think at ICMA for decades we've been looking to help the integration of capital markets and helping capital flow across borders, and we'll continue to work on avoiding unnecessary fragmentation wherever we can. But look, I'm sorry to say that we've run out of time. I could spend hours just listening to some more of your comments, but I know we don't have that time. So thank you very much indeed, Ashley, for your remarks today. We've covered a wide range of really important topics. I very much appreciate that. I know that our viewers will as well. So with that, I will let you go. This is Martin Scheck speaking with Ashley Alder, CEO of the Hong Kong Securities and Futures Commission. Thank you very much indeed.
Thank you, Martin.